There's an approach in investing that I don't hear a lot of people talking about anymore. And that approach is dollar cost averaging. Now, there are other approaches as well that we're going to discuss in this video. I want to talk about how to ideally invest for the very long term, not necessarily about the short-term trading around the player versus player game, around beating the market, around doing blockchain analytics. I want to talk about how to actually allocate assets over the long term that we can grow our wealth, because it's much harder than most people think. It's easy to grow your wealth just measured in US dollars over the decade, but it's very hard to grow your wealth measured in purchasing power. And not just purchasing power in terms of consumer goods that deflate anyways over time because of technological progress, right? It's easier to make the TV today than it was 10 years ago. So of course the TVs are cheaper. But what doesn't get cheaper is, say, the beach house property, right? The rare property, the apartment in the city center, etc. If you don't want to lose purchasing power against those things, that's much harder to achieve. So let's talk about different strategies, also of course in the context of Bitcoin. If you're currently at the beginning of your crypto journey and you don't yet have tens of thousands of dollars in crypto, then dollar cost averaging into Bitcoin is probably your best bet. Because this is how it works. Bitcoin is a fairly safe cryptocurrency. It does go down sometimes, but it tends to, over the very long term, recover. So when you buy Bitcoin at a suboptimal price, that's fine. Because if you simply just wait for another 5 to 10 years, you should be at a higher price long term, because there is long-term adoption of Bitcoin as a savings vehicle. So you can't do too much wrong with buying Bitcoin. Now, the reason why I like dollar cost averaging, especially for beginners that don't yet have a lot of crypto allocation, is because it aligns several interesting aspects. The first aspect is you can always tell yourself a good story. So if you buy Bitcoin today and Bitcoin goes up, then of course you made profit, right? You can tell yourself a good story, you made money. However, if you buy Bitcoin today and Bitcoin goes down, you can still tell yourself a good story, because you planned out to dollar cost average into Bitcoin anyways, right? You planned out on buying Bitcoin regularly every month anyways. So when Bitcoin goes down, you can tell yourself the positive story of, now I get more Bitcoin for the lower price and I'm in it for the very long term anyways. And so the more it goes down initially, the better, because I can scoop up all of those cheap Bitcoin and speculate on the long-term adoption trend. So no matter what direction Bitcoin goes, up or down, you're actually never really stressed out because you've got the long term in mind. So this is very nice about dollar cost averaging. You're never really timing the market in the wrong way. Now, another nice thing about dollar cost averaging is that your exposure to crypto is aligned. So your monetary exposure is aligned with your knowledge of crypto. So when you start buying out Bitcoin, right, for the first month, you probably don't know that much about Bitcoin yet. You've just on the periphery read maybe an article or two about this, maybe watched a few YouTube videos, but you're not really that deep into the whole space yet. If you continue to buy in, you're probably every now and then reading another news article. You'll maybe even pick up a book around Bitcoin. So your financial exposure will be aligned with your knowledge. And that's in general a very good thing to do. If you know a lot about property, then it makes sense to have the vast majority of your wealth in property. If you know a lot about stocks, it makes sense to own a lot of stock. And if you know more and more about crypto over time, it makes sense to have more and more exposure to crypto over time. That's another nice effect that a lot of people don't really talk about. But how effective is this dollar cost averaging approach? Let's talk about a somewhat medium-term time horizon. Let's talk about 4 to 5 years, the length of a typical Bitcoin cycle. Let's say you are an okay earner and you stash away $1,000 per month, right? That's how much you save in Bitcoin, $1,000 per month. And you do this over the span of, say, 3 years. So you have $36,000 worth in Bitcoin saved up. Now, Bitcoin goes in cycles, right? Normally, the growth periods are relatively short, but very aggressive, and Bitcoin can still do multiple X returns. Let's say we are in a bull run and Bitcoin makes a 4X, okay? Or let's say a 5X. Your 36K will turn into 180K. So you only saved for 3 years and you only saved $1,000 per month, and you will have $80,000 at the end of a bull run that you can then diversify with, right? When you are that high, you probably want to put some of that money into stocks, maybe into long-term government bonds, maybe into gold. You don't want to be that much exposed to Bitcoin at that point in time anymore, because you don't want to see a 50% drop anymore if you only saved $1,000 every month. So this is how strong of a lever dollar cost averaging is. Those are not unrealistic numbers. This is real. You can really start this today. You can really just put $1,000 every month into Bitcoin. And I believe that in 4 or 5 years, you're very likely going to approach the 200K mark with your portfolio. It's very, very realistic. It's not so realistic to buy a meme coin and expect it to 100x and pick the correct meme coin, right? This is gambling, this is lottery. But if you work very systematically on saving in Bitcoin over a few years, you can become somewhat wealthy already in a relatively brief period of time. It's really that simple. It's really not that complicated. It just takes a bit of discipline. And this is how I started out my whole crypto journey as well. For me, it wasn't $1,000. For me, it was only $500. But because Bitcoin was at an earlier stage at that time and it grew much more, I reached the 100K just with that DCA portfolio after a few years as well. It doesn't take that much. It just takes a few years and a bit of discipline, and you will have a nice nest egg. You will feel like you have moved up considerably in the social ladder, right? You will not be that worried anymore about the electricity bill or about any kinds of emergency situations, right? You will always have that money ready to be spent in case you really need it. Of course, you don't want to spend that principal anytime soon, but at least you've got something. Now, if you don't have the discipline to put in $1,000, right? If after 3 or 4 months, you think maybe I should buy that car and let's stop with the dollar cost averaging right now, right? If you don't have that discipline and at the same time you are okay to take on a bit more risk, then there is an alternative approach. That approach is very, very unconventional, and you have to follow me on this, because if you're simply just following the mass think, then you're probably not going to do this. But it might be the right thing for you. It very much depends on your overall setup. But let's say you have a very safe job, right? Let's say you're employed by the government, or you're with a company already for a very long time, and in case even if the company would lay you off, you will find another job in no time. Right, you've got a very stable source of income. This video is sponsored by the premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the premium membership. Feel free to check it out. What a lot of people would do is they would save up for several years until they've got a down payment on a house. Right, then they put all of that money in a down payment on a house. They lever up their investment by 5x, maybe 10x, right? If you have 10% down on your house, you lever up your investment by 10x, and then you're simply making money that way. This is super high risk, right? Because if the property market goes down just by 10%, you are now in negative equity. So you cannot really sell your house. You're stuck in that position. If you were to sell the house at the time, you've lost everything. So the selling pressure goes down as the price of the property market, as the prices go down as well. So there is a flaw to the property market simply because so many people are negative equity. But just think about how risky actually that endeavor is, right? You put in several years of your income in a house. You're speculating on this one single asset. You don't even know if that single asset goes up because you're not diversified whatsoever. You're not diversified across different asset classes because you're only in property. You're also not diversified across different assets within the asset class. You only own one house, not 100 houses. So it's hyper risky, but for a lot of people it does work out simply because you've got so much leverage and simply because people stick it out over the time, and all of the debt that you have on the house devalues over time due to monetary inflation. So this is how you get the high ROI on your equity. So it is a very common strategy, but it's not necessarily right now the best strategy because property prices are already very high relative to incomes, because financing costs are also very high right now, interest rates are high. So it's not necessarily the best, but simply just think about this when I now make another analogy. Think about how much risk you're actually taking. You're taking a lot of risk on a single asset with multiple years of income, a lot of financial risk. right? I'm not talking about all the other benefits of property investments that you don't have to move houses, etc. But yeah, just think about the potential volatility that you expose your wealth to with buying a house on 10x leverage by just putting down 10%. Now let's talk about Bitcoin, right? Because this is Bitcoin strategy. This is a crypto-related channel. What you can do is you can go into Bitcoin with leverage when Bitcoin is highly depressed. Now, how can we determine that Bitcoin is highly depressed? We again look at the average cost basis that the market has. So there's a measure called the realized price. So we're looking at all of the Bitcoin that has ever moved, and we look at the price, at what price did the Bitcoin move at the time. We look at that specifically, and then we see, is the market currently in losses or it currently in profit? So the average cost basis of the market is the realized price. When the current price is below the realized price, the market in aggregate is in losses, and that means the selling pressure goes down massively. In other words, a recovery at some point is very likely. We tend to not fall that much below the realized price. Maybe 30% historically, that's the absolute maximum. So if you're currently below the realized price, it does make a lot of sense to get heavily into Bitcoin. And you can do this with leverage in a similar manner how you would buy into property. So what I personally did is I bought a ton of Bitcoin when Bitcoin was at 20K. I took out a personal loan for 1 year worth of my salary, and I put this into Bitcoin at 20K. And then Bitcoin moved all the way up to 72K. And I actually sold one day after the all-time high based on another indicator. But if you're following this channel, you already know this, how I figured this out. If you don't know this yet, then simply just follow this channel. Feel free to subscribe. I publish videos regularly. So what you want to do is you want to enter a personal loan, and you want to have this for long enough of a duration that it will be very, very easy for you to always serve that loan. So if you make this over the duration of, say, 6 years, then you only have to pay 10% of your income to serve that loan. So if your income is super safe, and again, this was the assumption of this video, you should be able to stash away 10%. If you can stash away even more, if you can stash away consistently 20%, that's even better, then you can pay off the loan after 3 years. But you take on 1 year worth of your income, you buy this when Bitcoin is depressed below the realized price, and then you wait for the price to shoot up, make another 3-4x, and that's then when you sell at least partially your position. It's a high-risk play, but it's also a high-level play. It's also a play that makes a lot of money in a comparatively brief period of time. And it's not necessarily that high risk if you consider your income to be stable. Or if you at least have a side hustle, right? This is what you could also do. You could change your job, increase your income by 10, 20%, and simply have more income that way and serve the loan in that way. You could also add another side hustle, thus increasing also stability of your income, because if you've got multiple sources of income, if one of those sources suddenly goes down the drain, you at least have the other source, so you won't be that stressed. So you can have another side hustle of maybe 50% of your current main hustle income. You can save up all of that 50%. You can take out that personal loan that maybe costs 20% of your initial income, and you should be more than safe enough. So this is how to think about this, right? This is how you can get massive leverage in the market and make a lot of money. And this is how I personally did this. And yes, this is of course hyper controversial, right? Who takes out a personal loan of a year of income and puts this into crypto? But if you do this smart, right? If you do this when crypto is super depressed, and when you do this in a cryptocurrency that's very likely going to recover, which is Bitcoin, right? If you don't bet this on Dogecoin, but you bet this on Bitcoin, and if you do this over a long enough period of time, if the duration of your loan is long enough that it's very easy for you to serve this, and if your income is very, very safe, and if you maybe even have another side hustle to complement your main hustle, that in case your main income would suddenly be gone, that you would still have something to fall back on. If you do all of those kind of things, then in aggregate, this, I believe, is not that risky. I believe this is actually way less risky than taking out that mortgage. So just think about this in terms of portfolio volatility. Just think about this in terms of risk of ruin, right? The risk of ruin goes up as you take out a loan, but you can reduce that risk of ruin by having an additional job or by having long enough of a loan duration. Think about it that way, and that way you can make even more money than just with the standard dollar cost average approach, because you go full power all in when Bitcoin is hyper depressed and you do the ultra contrarian move. then everybody will declare you as super insane because nobody wants to have anything to do with Bitcoin when it's that low. And that's the time when you go hyper risk on with the move that nobody else would do. It's super common to take out a loan for a car. It's super common to take out a loan for a house. But a car goes down in value, right? A house appreciates in value, but is that high of a loan that the portfolio volatility is super extreme as well. If you compare this approach just in financial terms, right, of taking out 1 year of personal income when Bitcoin is below its realized price, which by the way, it's currently at around 30K. If you do that, you're actually financially speaking not doing a riskier move. I believe you're doing a less risky move, a move that also has a ton of upside potential. It's super contrarian, but you can't do what everybody else is doing if you want to get outcomes that are above what everybody else is doing. And this is, I believe, an approach that is very, very controversial, but I think is very, very profitable if you set it up right. If you got something out of this video, feel free again to subscribe. Feel free to also give this a like. There's also a Telegram channel down below. Feel free to check it out. Looking very much forward to chatting with you in Telegram. Cheers.